Oil is the engine of modern civilization. From fueling cars and airplanes to producing electricity and plastics, oil touches nearly every part of our lives. But have you ever wondered why oil prices change so often? Why do wars, pandemics, or even a meeting of oil-producing countries send prices skyrocketing or crashing? And here's something even stranger. How can oil prices go negative? Today, we'll answer these questions and more. We'll explore the history of oil, how it's priced, how global markets work, and why organizations like OPEC wield so much power. By the end, you'll understand how oil connects every part of the global economy and why it matters so much. What is oil and why is it so special? What makes oil so valuable? First, it's a fossil fuel that stores energy from plants and microorganisms buried millions of years ago. Over time, heat and pressure transformed this organic material into crude oil. But what makes oil stand out is its incredible energy density. It packs a lot of energy into a small amount. For instance, think about burning wood. Sure, it can generate heat, but it takes far more wood to produce the same amount of energy as a small amount of oil. A single barrel of oil contains the energy equivalent of burning hundreds of pounds of wood. Unlike coal, which is bulky and solid, oil is a liquid, making it easy to transport and store. It's also versatile. It can be refined into products that power our modern world: gasoline for cars, diesel for trucks, jet fuel for airplanes, and even non-energy products like plastics, fertilizers, and asphalt for roads. From oil to energy, how it powers the world. But how does oil turn into energy? Let's break it down step by step. Crude oil is sent to refineries, where it undergoes a process called fractional distillation. In the refinery, the oil is heated to extremely high temperatures in a distillation tower. Different parts of the crude oil, called fractions, are separated based on their boiling points. Gasoline is lighter and rises to the top. Diesel and jet fuel settle in the middle. Heavier products like asphalt remain at the bottom. Here's how these products are used. Gasoline powers the engines of cars you see every day on the road. Jet fuel keeps planes in the sky. Diesel drives trucks and machinery that transport goods across the world. Heavier byproducts are used to pave roads or as raw materials for industrial processes. This versatility is why oil powers over 60% of transportation globally. Without oil, moving goods, people, and even running industries would look very different. And that's why oil is so central to our economy. The discovery of oil. How it all began. Oil has been known to humanity for thousands of years. Ancient civilizations discovered it seeping from the ground, and while they didn't drill for it, they still found ways to use it. The Mesopotamians used crude oil to waterproof boats and construct roads. The Chinese used oil as lamp fuel over 1,000 years ago. The Egyptians used bitumen, a type of crude oil, to preserve mummies. Back then, oil was important, but it wasn't revolutionary. The Industrial Revolution in the 18th and 19th centuries changed everything. As industries grew, so did the need for energy. Coal powered most machines, but it was dirty, bulky, and inefficient for certain applications. Oil, with its higher energy density and liquid form, started gaining attention. In 1859, Edwin Drake drilled the world's first commercial oil well in Pennsylvania. For the first time, oil could be produced in large quantities. At first, oil was used mainly to make kerosene for lamps. But something even bigger was about to happen. In the late 19th century, the invention of the internal combustion engine transformed oil from a niche resource into the backbone of modern life. Cars, planes, and even factories now needed gasoline and diesel, both made from oil. What made oil so important? It wasn't just about lighting lamps anymore. It was about powering machines, transportation, and an entirely new way of living. This was the moment oil became the lifeblood of industrial society. The rise of Rockefeller and Standard Oil. Before Rockefeller, the oil industry was like the Wild West, chaotic and messy. Imagine this. Someone discovers oil, and within months, hundreds of others rush in to drill in the same area. Every driller sets their own price to sell oil, and to beat the competition, they keep lowering those prices. This price dumping made oil ridiculously cheap sometimes, but also caused companies to go bankrupt when they couldn't make a profit. It was a boom and bust cycle that left the industry unstable and unpredictable. Then came John D. Rockefeller. He saw the chaos and decided to take control. In the late 1800s, Rockefeller started Standard Oil, a company with one big goal: make the oil business organized and efficient. Rockefeller's plan was simple. He bought out his competitors so there was no more price war. He controlled every step of the process: drilling the oil, refining it, transporting it, and selling it. With this system, he could produce oil cheaper than anyone else. By the 1880s, Standard Oil controlled 90% of the oil industry in the US. That meant Rockefeller decided what prices people paid. For consumers, this was both good and bad. On the one hand, Rockefeller made oil products like kerosene more affordable and reliable. On the other hand, he had so much power that he could set prices however he wanted to maximize his profits. Eventually, people and the government felt Rockefeller had too much power. In 1911, the U.S. Supreme Court ruled that Standard Oil was a monopoly and forced it to split into smaller companies. Some of the companies created from Standard Oil, like Exxon, Chevron, and Mobil, are still giants in the oil industry today. Oil in the 20th century, the Seven Sisters. By the mid-20th century, oil production was dominated by a group of powerful Western companies known as the Seven Sisters, including Exxon, Shell, and BP. These companies didn't just operate in their home countries, they controlled oil production in regions like the Middle East, Venezuela, and North Africa. But how did they gain so much control over other countries' oil? It started with technology and money. Many oil-rich countries lack the resources, expertise, and infrastructure to drill for oil, refine it, or transport it. Western companies stepped in, offering their technology and funding to develop these countries' oil industries. In exchange, these companies signed long-term contracts that gave them control over oil production. For example, in Saudi Arabia, American companies formed Aramco, now Saudi Aramco. In Iran, the Anglo-Iranian Oil Company, later BP, controlled the country's oil industry. But these deals were heavily skewed in favor of the Western companies. The producing countries received only a small percentage of the profits, often as little as 10 to 15%. Meanwhile, the Seven Sisters controlled the oil, set the prices, and kept most of the wealth. This created a sense of resentment. Oil-producing countries felt they were being exploited. They provided the natural resources, but most of the benefits went to foreign companies. Over time, this imbalance fueled the desire for oil-rich nations to take back control of their resources. This growing frustration would eventually lead to the creation of OPEC, a turning point in the history of oil. Why OPEC was created? By the 1960s, oil-producing countries were frustrated. Western companies like the Seven Sisters controlled oil production, set prices, and kept most of the profits. Meanwhile, the countries that actually owned the oil fields were left with only a small fraction of the earnings. In 1960, Saudi Arabia, Iraq, Iran, Kuwait, and Venezuela decided it was time to take back control of their resources. These 5 nations came together to form OPEC, the Organization of the Petroleum Exporting Countries. Over time, more oil-rich nations joined OPEC, including Algeria, Nigeria, Libya, Qatar, and the United Arab Emirates. Today, OPEC has 13 member countries, controlling about 40% of the world's oil supply and a significant share of global oil reserves. OPEC was created with three main goals: take control of oil production and break free from Western dominance, coordinate supply to influence global prices, ensure their countries received a fairer share of the profits from their natural resources. So, how does OPEC affect oil prices? It's all about supply and demand. If OPEC decides to cut production, less oil is available and prices rise. If OPEC increases production, the market is flooded with more oil and prices fall. By coordinating production, OPEC gives its members more power over the global market, preventing chaotic price wars that often occurred in the past. But why is there just one global price for oil? Why couldn't countries like Saudi Arabia sell oil to their neighbors at a different price? Here's why. Oil is a global market. If one country sets a higher price while another sets a lower one, buyers will simply choose the cheaper oil. To ensure consistency, oil prices are tied to global benchmarks. The two most common ones you've probably seen are Brent crude and West Texas Intermediate, WTI. Let's break it down. Brent crude comes from the North Sea, off the coasts of the UK and Norway. It's a global benchmark because it's widely traded and easy to transport by sea. West Texas Intermediate, WTI, comes from oil fields in the United States. It's lighter and sweeter than Brent crude, meaning it has less sulfur and is easier to refine into gasoline. So, when you hear about oil prices on the news, they're usually referring to Brent crude or WTI, which represent the standard prices that buyers and sellers around the world use as a reference. By controlling how much oil is pumped into the market, OPEC ensures that prices remain stable, or, at least, favorable to its member countries. But with great power comes great controversy. OPEC's control over oil supply has often put it at the center of geopolitical tensions and economic debates, as we'll see later in this video. How oil is transported. Once oil is produced, it's transported to refineries and consumers. The main transportation methods are pipelines, the most efficient way to move oil onshore. Tankers. These massive ships transport oil across oceans, making up most international oil trade. Trucks and rail, used for smaller-scale transportation. Globally, over 60% of oil is transported by tankers, while pipelines handle most domestic movements in countries like the US and Russia. The role of futures markets in pricing oil. Let's talk about how oil prices are set. The price you see, say $110 per barrel, isn't the price of oil you can buy and get delivered to your doorstep today. Instead, it's usually the price of the nearest futures contract. A futures contract is an agreement to buy or sell oil at a set price on a specific future date. Think of it as locking in a price now for oil you might need later. Let's break this down step by step with an example. Today is January 27th. The price you see, $110 per barrel, might reflect the February futures contract expiring on January 31st. As January 31st gets closer, the futures price and the spot price, the price for immediate delivery, start to converge. Why do they converge? Because as the contract's expiration date arrives, traders expect the price of oil in the future to match the price of oil being delivered immediately. It's like saying, if I need oil tomorrow, its price will probably be the same as it is today. Here's the important part. Only about 1 to 3% of futures contracts actually result in physical delivery of oil. The rest? They're traded by speculators, traders who buy and sell contracts to profit from price changes without ever handling the oil itself. For example, if a trader buys a futures contract for $100 per barrel and sells it a week later for $110, they pocket the $10 difference. It's all about making money from price movements, not storing oil in their backyard. Physical delivery happens at specific locations like Cushing, Oklahoma, which acts as a major storage hub for U.S. oil. But for most traders, it's all about cash settlements. They don't want barrels of crude showing up at their door. This is why futures trading is so important. It sets the price of oil globally based on what traders think oil will be worth in the future. It provides a way for oil producers and consumers to hedge against price changes. What are petrodollars and why are they traded in dollars? Why is oil traded almost exclusively in US dollars? It's a story that starts in the 1970s with a deal between the US and Saudi Arabia that reshaped global oil trade. But that's not the full picture. It goes even deeper. First, let's step back to 1944 and the Bretton Woods Agreement, which made the US dollar the backbone of the global financial system. After World War II, the dollar became the world's reserve currency, tied to gold and used for international trade. This set the stage for oil to be priced in dollars. By the 1970s, the US faced an oil crisis. OPEC countries had cut exports, oil prices had skyrocketed, and economies worldwide were struggling. To stabilize the situation, the US struck a pivotal deal with Saudi Arabia, the largest OPEC producer. Here's what the deal included. Saudi Arabia agreed to sell its oil exclusively in US dollars. In return, the US guaranteed military protection and access to American financial markets. This deal not only cemented the dollar's role in oil trade, but also influenced OPEC as a whole. Over time, other oil-producing countries followed Saudi Arabia's lead, and oil became almost entirely traded in dollars. Why did the rest of the world agree to trade oil in dollars? Stability. The US dollar was the most stable currency after World War II. Global trust. With the largest economy, the US was seen as a reliable partner. Efficiency. Using a single currency simplified international trade and avoided complex currency exchanges. This system created what we now call the petrodollar system, where countries need to hold dollars to buy oil. These dollars often flow back to the US, invested in bonds, companies, or infrastructure, strengthening the US economy. Not everyone has been happy with this system. Over the years, some countries have tried to break away from the petrodollar. In the early 2000s, Iraq under Saddam Hussein began selling oil in euros. Shortly after, tensions with the US escalated. While there were many reasons for the conflict, some believe this shift away from the dollar played a role. Similarly, in Libya, Muammar Gaddafi proposed that African countries trade oil in a gold-backed currency. This would have reduced reliance on the dollar. Not long after, Libya faced international intervention and regime change. Today, China and Russia are leading efforts to challenge the petrodollar. For example, some oil deals between Russia and China are now conducted in yuan instead of dollars. While these efforts are growing, the dollar still dominates global oil trade because of its trust, liquidity, and established role in the financial system. The petrodollar system has been a cornerstone of the global economy for decades, giving the US enormous financial influence. However, with countries exploring alternatives, the future of the petrodollar is one of the most important questions in global trade. Why oil prices fluctuate? Why do oil prices go up and down so often? It all comes down to four major factors: supply and demand, geopolitics, OPEC decisions, and speculation. Let's break these down. Supply and demand. Oil prices rise and fall based on how much people and industries need it, or don't. This is called demand. Take COVID-19 as an example. During the pandemic, planes were grounded, so airlines didn't need jet fuel. Factories slowed down or shut completely. People stayed home instead of driving. This sudden drop in demand caused oil prices to plummet. In contrast, during times of economic growth, when people are traveling more and factories are working at full capacity, demand rises, pushing prices up. Geopolitics. Wars, sanctions, and political instability in oil-producing regions can also cause prices to spike. Why? Because they disrupt supply. For instance, in 2022, the conflict in Ukraine and sanctions on Russian oil reduced global supply, sending prices higher. When a major producer can't get its oil to market, the reduced availability drives prices up globally. OPEC decisions. OPEC also plays a huge role in oil prices. They control about 40% of global production, and when they adjust their supply, the whole world feels it. If OPEC decides to cut production, less oil is available and prices rise. If they increase production, prices fall because there's more oil in the market. For example, during the 1973 oil crisis, OPEC drastically cut oil exports, causing prices to quadruple in just a few months. That decision reshaped global energy policies. Speculation. Speculation is another big factor. Traders on futures markets bet on where oil prices will go based on current events, weather forecasts, or even their own hunches. Sometimes, speculation amplifies price swings. For example, if traders believe supply will tighten because of a potential war or OPEC decision, they'll drive prices up, even before anything actually happens. So, why do oil prices fluctuate? It's a mix of demand from people and industries, geopolitical tensions, OPEC's production choices, and the ripple effects of speculation. These factors combine to create the dynamic, constantly shifting oil prices we see every day. But what happens when all these factors collide, like during COVID-19 or the 1973 oil crisis? Sometimes, the results can be shocking, even leading to prices going negative. Let's explore the 2020 negative oil price crisis. April 2020 was a moment no one saw coming. For the first time in history, oil prices went negative. That's right, producers were actually paying buyers to take oil off their hands. But how did something so strange happen? Let's break it down. First, let's go back to the start of 2020. COVID-19 turned the world upside down. Planes were grounded, airlines didn't need jet fuel, factories shut down, manufacturing slowed or stopped completely. People stayed home. No one was driving or commuting. This led to a collapse in demand for oil. Normally, oil powers the global economy, but during the pandemic, the world just didn't need as much oil. At the same time, oil producers didn't slow down fast enough. They kept pumping oil out of the ground. Why? Because shutting down an oil well isn't as simple as flipping a switch. Many producers had long-term contracts to fulfill. Some wells are expensive to stop and restart. The result? A massive oversupply of oil. Producers had nowhere to send it, and storage tanks, especially at Cushing, Oklahoma, the main storage hub for U.S. oil, started to overflow. Here's where it gets tricky. Most of the oil price you see is based on futures contracts, agreements to buy or sell oil at a future date. For the contract expiring in April 2020, traders holding those contracts were suddenly faced with a harsh reality. If they didn't sell their contracts before expiration, they'd be responsible for taking delivery of the oil. With storage tanks full, there was literally nowhere to put the oil. When no one wants to take delivery, the price doesn't just fall to zero, it goes negative. Traders were essentially saying, "I'll pay you to take this oil off my hands because I have no way to store it." On April 20th, 2020, the price of WTI crude oil dropped to negative $37 per barrel. It wasn't just cheap, it was a liability. This might sound shocking, but it's all about logistics. The negative price didn't mean oil had no value. It meant storage costs were so high that holding on to oil became a financial burden. Traders who couldn't find storage had to pay others to take the oil away. Thankfully, this was a temporary crisis. As economies reopened and demand recovered, oil prices climbed back into positive territory. But the 2020 negative price event is a perfect example of how supply, demand, and storage all work together to shape oil markets. In the end, negative oil prices weren't as mysterious as they seemed. They were the result of a perfect storm of oversupply, collapsing demand, and storage limits. Everything has its explanation, and this crisis was no exception. Why the U.S. drills and imports oil simultaneously. The U.S. is the largest oil producer in the world, yet it still imports millions of barrels of oil every day. Why? It's all about the type of oil and how refineries are designed. Not all crude oil is the same. U.S. refineries, built decades ago, were optimized to process heavy crude, the thicker, harder to refine oil often imported from countries like Canada and Venezuela. But much of the oil produced in the U.S. today is light crude, which is easier to refine, but not always compatible with these older refineries. To make this work, the U.S. imports heavy crude for its refineries. At the same time, it exports light crude to other countries, like those in Asia and Europe, where refineries are better equipped to handle it. So, even though the U.S. produces a lot of oil, it's not always the right kind for its refineries. That's why the U.S. both drills and imports oil. It's all about matching the oil to the refinery. Is oil running out? We've all heard it before. The world only has 50 years of oil left. It's a claim that's been repeated for decades. So why hasn't oil run out yet? Let's break it down. Here's the truth. Oil isn't endless, but we keep finding new reserves and new ways to extract it. Thanks to advances in technology, oil that was once impossible to reach is now accessible. But let's clear something up. When you hear about proven reserves, this only refers to the oil we currently know how to extract economically with today's technology and prices. It doesn't mean that's all the oil in the ground. As technology improves, more of what's underground becomes part of these reserves. Take fracking, for instance. Back in the 1970s, geologists knew there was oil trapped in shale formations, but they didn't have the tools to extract it efficiently. Shale oil is locked in dense rock, making it impossible to drill with traditional methods. That changed in the 1990s and 2000s with the development of fracking, a process where high-pressure water, sand, and chemicals are used to crack the rock and release the oil. When combined with horizontal drilling, it unlocked massive reserves in places like the Permian Basin in Texas and the Bakken Shale in North Dakota. By the 2010s, this revolution turned the U.S. into the world's largest oil producer. For the first time in decades, the U.S. started exporting more oil than it imported, transforming global trade. Fracking made the U.S. an energy powerhouse, reducing its reliance on imports and challenging the dominance of traditional oil exporters like OPEC. It didn't just reshape the U.S. economy, it changed the entire global energy market. When you hear 50 years of oil left, that number is based on proven reserves, what we know how to extract with current technology. But as technology evolves, we keep adding to those reserves, extending the timeline. For instance, Brazil recently discovered massive offshore oil fields, now major contributors to global production. Innovations in mapping and drilling have turned areas that were once considered empty into highly productive oil fields. This doesn't mean oil is infinite, it's a finite resource, but predicting when we'll run out is tricky. So, while oil won't last forever, it's not running out as quickly as many feared. Thanks to new discoveries and better technology, the clock has been extended. And as renewables like wind and solar take center stage, our dependence on oil will gradually decrease, giving the world more time to transition. The future of oil. With the rise of renewable energy and electric vehicles, many people think oil is on its way out. But is that true? Not so fast. Oil is still critical for things we can't easily replace. Even if EVs replace gasoline cars, planes, ships, and trucks still depend on oil. Jet fuel, marine fuel, and diesel are hard to replace with alternatives right now. Plus, industries rely on oil to make products like plastics, chemicals, and even medicine. For instance, every plastic water bottle or synthetic fabric you use likely started as oil. While oil demand for cars may drop, sectors like aviation and shipping will keep using oil for decades. And let's not forget developing countries. While wealthier nations focus on renewables, Many developing economies are still increasing their use of oil to fuel growth, build roads, and power factories. The future of energy will be a mix. Renewables like wind and solar are growing fast, but oil will remain essential for planes, ships, factories, and plastics. It's not going away anytime soon. Like and subscribe for more videos that make economics simple.